To diversify risk and return expectations across multiple markets, many choose to invest in ETFs. But which portfolio strategy is best? Here's an overview of the dominant approaches: long-term investing or holding. One strategy popular among ETF investors is simply long-term investing. In a nutshell, it's based on the belief that the assets that the ETF fund tracks are in a long-term uptrend. Long-term investors typically don't pay attention to temporary market conditions and are not inclined to sell their holdings in ETFs. Speculating. Typically, speculators have a short to medium-term investment horizon. Often, the assumption is to play out a specific scenario. This could be, for example, buying a gold price ETF in anticipation of an economic slowdown and the weakening of the US dollar. On the other hand, speculators can also choose ETFs that offer exposure to specific market sectors like new technology or healthcare. Trading. Active traders use several indicators, including technical analysis, to open positions. Traders are usually in the market for the shortest time and keep positions open for several days or even just hours. They often choose CFD instruments on ETFs, which are characterized by leverage. Leverage increases investment risk while allowing them to open larger positions and reap greater profits or losses. Dollar cost averaging. Some investors believe that the key strategy to reap long-term investment benefits is called dollar cost averaging, or DCA for short. This means buying selected ETFs regularly without paying attention to market sentiment or current market conditions. Instead of opening one large position, investors who practice DCA open a series of smaller investments at regular intervals regardless of price. Momentum. Momentum investors wait for the right moment to start investing. This is usually when the mood is negative or an event happens that they believe will trigger additional demand. For example, this could be the expectation of news that improves sentiment around a particular sector or selected company's stock. For example, the rise of AI and euphoria in technology stocks and chip makers. Following the trend. Investors who are uncomfortable with buying when the stock market is losing tend to choose the strategy of investing along with the trend. Following the trend is your friend principle, such investors plug into ongoing market trends. Contrarian. Contrarian investors believe that the majority in the market is usually wrong. Even if the consensus is right, contrarians can expect a moment when the market's optimism or pessimism is exaggerated. They're usually very active during stock market panics and crashes. Subscribe to XTB to stay up to date to learn more about trading and investing.